Welcome to Tech Talk. I'm your host, Carla, and with me is my fellow co-host and CMT, David Blake. It's the first Monday of the month. It's July 1st, 2024, and we have some activity to talk about that happened in the stock market last week, along with some interesting things to look out moving forward. We do it mostly from a technical perspective. David, I hope they had a great weekend. How are you
That was
doing
great.
today?
I'm doing well. Thank you.
Great. Well, let's get started by taking a look at last week's market activity.
All right, well, we had a little bit of a volatile week last week, mainly because of a little bit of a sell-off in semiconductors. Nvidia was kind of briefly repriced last week. We saw it from its intraday high, actually from the week before on a Thursday, down to its low, I believe, on Monday last week. It had fallen off about 16%, which kind of caught everybody off guard a little bit, especially the fast money. So after that, we did get a little bit of a bounce back. We had some back and forth trading as you know, in the short week, as investors were kind of waiting for some key inflation data. The main thing they were looking for was the PCE, which came out on Friday morning. That's the Fed's preferred inflation gauge, and it showed that inflation is still ticking a little bit lower, but still showing that a little bit stickier than what we're hoping for. You know, we made some great progress last year, and now as we're getting the last percent or two, it's a little tough. It's a little choppy on this road here, a little bumpy, trying to get inflation back down to 2%. But we'll see what happens with that because it's so bumpy. It's hard for the Fed to talk about getting a rate hike. And in fact, we had several Fed officials last week talking earlier that they're just very reluctant to want to bring down rates too quickly. It happened back in the 70s where they brought them down too quickly, and then inflation raced back up again. They don't want that to happen. That was like a double whammy that threw us into a big recession. We did see yields. They ticked maybe a little bit higher and lower during the week. They didn't really do much of anything. The 10-year ended up at 439. The 2-year landed at 475. That wasn't too far off where they started the week. We did see crude oil prices continue higher for a third week. Now off of the June 4th low of 73 and a quarter, they closed at 81.50. That's an 11% hike in oil prices. That's pretty much just because of the Israel and Hezbollah expansion thing that's going on right now. That could, if they would just go to war a little bit, that would probably push oil prices back up towards 90. So I think the energy sector and some of the oil stocks right now are probably a place that you want to have as just kind of a conservative investment area that go along with your tech shares. The market sectors were also mixed. We had, you know, with strength in energy and communication services and REITs, and then utilities, materials, technology, and consumer staples were the worst performing market groups. In technology, mainly because of the pullback in semiconductors. I think the semiconductors were down about 3% last week. Now they've almost had a parabolic move higher, so that wasn't a big deal. I think the Nvidia came down to about its 30-day moving average. And let's see where the semiconductor index came down. It also came down to about the 30-day moving average. I mean, it's got a long way to go. Today we're around 54.46 on the SOX, and the 50-day moving average is all the way down to 5088. So it's about 8% lower before it would even get to a key support level. So I think it's fine. We're off a little bit again today. But you know, again, it was so overbought. You had the 14-day RSI up around almost to 80, I believe, which is ridiculous for how far it was. I also saw something to me. I think it was in the video. It was something like 38% of its 50-day moving average. With most stocks and most indexes, when they get about 12%, considered to be overbought. So I would just call this a healthy repricing on some of the semiconductors and Nvidia before, you know, we start to move a little bit higher on that. So we had the short week. We got some of the key jobs that coming out this week. In fact, tomorrow we get JOLTS on Tuesday. Then on Wednesday we have the ADP employment number coming out. Then we get the Labor Department's big payroll report on Friday. Right now they're looking for about 190,000 to 200,000 jobs added. That's down from 272,000 in May, which seemed a little out of whack, but we'll see what happens with that. The unemployment rate did go up to 4% in May, and they expect that to remain at that 4% level. Now, as far as the technical condition in the market goes, it's positive. We didn't see a big change. As we went into Friday, the S&P 500 and NASDAQ actually punched new highs in the morning after that PCE report, but gains were unable to hold. We sold off in the afternoon. Technical indicators are mixed with that sell-off and sideways market that we've had for the last, say, 2 weeks. MACD is a short-term trend gauge. It crossed into bearish territory, and momentum is positive, but it also is slowing. So just kind of some indecision as we go into the into July. Part of that is because of the debate. Today we have rates ticking up a little bit. That's due to some political uncertainty for the debate. Secondary indexes that we saw last week, they outpaced the major averages, which is good in the longer run. We had the Dow Jones Transportation Index and the small cap Russell 2000 break out above some key moving average resistance areas. We also had the transports break out of a bullish double top point and figure chart pattern. And we have the Russell 2000 looked like it was getting ready to reverse the X's and O's on this point and figure chart and possibly come up and challenge to do a triple top breakout. But this little uptick in rates today, stocks are struggling, and especially small caps need to see rates lower before they're going to do anything. And I believe the 2000 is down almost 1% again today. That's not what we want to see. We're going to need to see some, a rate cut before we get that. In fact, today, we saw the Russell 2000 drop back below its 50 and 100-day moving average, which is a negative. It does have support for 2009 right now. Big support is down here around 1977. Don't know if we'll get that low or not. Kind of depends maybe on some of this payroll action we get today. We don't want to see a real strong jobs report, but we also don't want to see too weak of a jobs report this week. The reason being there, a too weak of a report where we start seeing unemployment tick up to 4.2, 4.3. That's something that's hard to stop. That means that a soft landing for the economy is really going to become in question. So a Goldilocks number this week for the payrolls would be around 200,000. If we can keep around there, but maybe 180, 175, that'll be good for the market in general. We start getting up where it jumps down to maybe, under 100,000. You're going to probably that means a lot of people are getting laid off, and you're probably going to see more people talking about a bumpy, or not able to maneuver a soft landing. Okay, underlying breadth last week again continues to be very anemic. Usually when you're seeing a market breaking out to new highs, and again the NASDAQ and the S&P 500 did break out to new highs on Friday intraday before ending the day lower. So those were kind of bearish engulfing candlestick patterns, and the NYSE and NASDAQ advanced decline lines, we consider those to be leading indicators of market direction. They're just going sideways to down a little bit. I think both of them were just a tad higher. By that I mean 900 units to maybe 1,000 units. When you have a nice wide broad-based participation in a rally, you can see the AD lines picking up 3,000 and 4,000 units during the week. The fact that we're getting 300 in 1 week, down 200 last week, the NYSE was up 900 units. That's not supportive of a rally that you want to be participating in. It just means that you have a very narrow group of stocks that are leading the market higher, and of course in this case that's the Magnificent Seven. And despite all these underlying negative divergences, you still have everybody too bullish. I think if they understood some of this underworkings in the market, that they would certainly be beginning to get a little bit more cautious rather than being this bullish. I mean, you have the bulls there's 3 times the number of bulls to the bears in the Investors Intelligence Survey. And then for the retail investors, the American Association of Individual Investors shows that 33 of the last 34 weeks polls have been above the historical average of about 37.5%. And last week they came in at 44.5%. So even the retail clients, despite, if you look at some of these charts, not, going sideways, they're overly bullish. A lot of, of course, that's like I wrote 2 weeks ago, that's kind of the power of what the Fed's rate cut program can do. And everyone pretty much expects the rate cut as early as September. That's still up in the air, although I believe we had about 62% probability of that showing up on the CME FedWatch thing on Friday, which is up from about 40% at the beginning of June. So despite what's going on in the market, I do think that you need to be still need to be a little bit more cautious in here. Historically, you get a pretty good, a pretty decent July, especially the first 2 weeks. They're normally up. We just finished the best 6-month period before an election in the last 50 years for the S&P 500. I think that momentum will probably carry a little bit longer. But our CTI, which is our proprietary market timing indicator, is going to flip to a bearish market posture, a negative reading, and bearish market posture. Maybe not this week, but possibly next week. That's something that we need to be aware of. And I would not be surprised at all to see this market with the uncertainty in the election now. I expect to see the market have a kind of a rough time towards the end of July. Say, over the next 2 weeks, you may be thinking about, maybe lightening up on some positions. If you're in margin, you certainly want to start to come off of that. And again, if you want to look at a couple of the different sectors where you may want to, what might be affected if the market weakens up here. Carla, can we go to Stock Watch and look at the chart feature that we were talking about earlier?
Yeah, sure thing. So this is my stock watch list here, and then I have my SPDR sectors. And then if I would like to see the chart view, just go ahead and click here.
In this chart view that Carla just put up, this will take your list of stock watch things you're looking. You get your, you look at your relative strength, and you look at your power numbers and all that kind of stuff, and you're looking for what's been upgraded, downgraded. But if you just want to look at what's really going on in with some of these charts, it's a little bit easier. Sometimes, a picture's worth 1,000 words. When you see the graphs with all the numbers going up and down, sometimes it's hard to imagine exactly what's going on. Like I just mentioned before, that the only sectors that we see, looking at new highs are XLC, the communication services, and you see that that's still moving up. Go ahead and go down the chart a little bit more, because I also, consumer discretionary XLY is still looking good. Where's that at? Okay, down here at the bottom. Okay, we got XLY. Move it. The reason that's up is mainly because of Amazon. It's in that sector. Maybe probably even Tesla. Tesla's starting to break out again to some newer highs. So that looks good. Go up to XLK, just above here a little bit. Healthcare actually looks okay. Here's a tech sector with XLK. Where it made the new high, that's where NVIDIA made the new high. Then we pulled back, and now we're moving up. So those are the ones that are they're still outperforming. The relative strength is still strong. And I mentioned that several groups that are more cyclical sectors seem to be range bound. Go ahead and go to the top of this again. And by range bound, what I mean is, okay, you have the spiders, you have the XLB materials, it's drifting down. Go ahead and go down the page again. Okay, energy looks like it's bottomed. As I mentioned back there early June, we kind of hit a bottom, and now we're moving up again. That's showing strength in the oil things. As you can see, the 14-day RSI below this, it's crossing above 50. You have the financial sector right next to that, and again, you see a sideways chart on this. Again, it really hasn't done anything since March. Again, the financial sector is probably going to need to see cut in rates before we're going to trade much higher in that. As you can see on the 14-day RSI below that, it's meandering sideways also, right around the 50 area. Not overbought, not oversold, but it's not showing any momentum. one way or the other, really. Go on down a little bit further. So that's one that again, the industrials, another one right here, XLI. Again, it's going sideways. You haven't done anything since March. And again, you can see the 14-day RSI meandering sideways again, not going anywhere. And these are areas that you want to watch as you're looking maybe for some areas to go. You hear the talking heads on TV saying, okay, well, we need to see a broadening out of the market. Maybe we'll see more money going into the cyclical side of the market. That they're exactly right in saying that. But until we actually get that rate cut or start to see that, we're not going to see the financials or the industrials going down this page a little bit more. Maybe healthcare, this type of thing, until we get those rate cuts. Some of these cyclical things, like again, especially the financials and industrials, and maybe even the materials, until we get that first rate cut, we're not going to see these stocks break out. And in fact, if we get the rate cut because the economy is showing signs of slipping, or the unemployment rate starts to pick up, that's not going to be real good for the cyclical stocks at first either. So that in that aspect, you may see a rate cut coming in, and those stocks still kind of moving sideways and not breaking out. So and this is something that you may want to look at even on your regular stocks, but I would be very cautious right at this point of saying, okay, well, I'm going to come out of my tech and my Google and my Amazon and my some of these big 7 stocks, and start buying the banks and the industrials, that type of thing, and some of the materials, because until you see the rate cut, which is going to start to get this economy going. Right now, we're looking at slowing economy. So you're not, that's not good for materials. It's not good for industrials, that type of thing. So until we get that rate cut, if you decide to take some profits in these Magnificent 7, and if they're more than say 20-25% one stock or so in your portfolio, you definitely want to start to trim back a little bit. Maybe get that down to a more realistic thing. You can always go back into it. You probably don't want to go all out all in. You don't want to be jumping around like that, because you can miss some of these things. A day that Meta fell, I think, from like 510 all the way down to 435 or something like that on its earnings, whatever happened. I bought it that day, and we're already back up to 510. So I would be looking at those stocks more as something to buy if you see a big crush, like maybe like in the video there, Dave. If you bought in the video on that big 60% drop, you've probably already made 10% or so. So go ahead when you go into that stock watch. That's something to an easier way to look at buy or sell. And of course, what we also do on here, Bill's done the text has done a really nice job on with the color coded. Go back to the chart thing there, and it's showing you resistance areas in pink and support levels in green. So you can see there, okay, well, this XLC, we're bumping up against some resistance over here in the pink area, but we've got some nice support in here around the 85, 84 and a half area. And that'll give you something. If you see something break down below there or break through resistance, okay, you can easily see that not only is this thing a buy, but we're breaking through some resistance levels. This is great. Okay, when I talk about the XLC making a new high, and in fact, just back here in June and May, we broke out of a double top point and figure pattern, which is a nice bullish pattern. So if you're looking at some of these things, go here to materials. Let's look at that real quickly. Point and figure up at the top.
Oh,
actually, no, go to energy. I'm sorry. Go to the energy XLA right there to the left.
okay.
Let's go to the point and figure on this. Okay, so now you've gotten a reversal. You had the big long string of zeros, which just means it's the trend is down, and now you've gotten a reversal here with the X's on energy. So we can see that XLE going up here. Once it gets up to 90, 96, we're at 92 right now. You'll get a double top breakout. That would be a bullish sign for that. It also shows you get these X's and O's will also show you support and resistance. In other words, 88 would be a break below that, means oil's probably going down again. And another crazy thing that you can do with point and figure charts is if you take that top X over here around just above 98 on the XLE, you can actually draw trend lines. And in this case, 93 is going to be a trend line resistance area for XLE. If we break above that, you're probably moving higher. And that's just a little, technicians thing that we look at drawing on those things. So look at some of these things, these sectors. And again, I do not think you should be jumping in saying, okay, we're going to broaden out on this rally and let's go into the cyclicals. The charts you're looking on those, the sideways action, you're going to need to see that coming in before you're going to see these things start to break out.
Okay, great. Well, yeah, that was super helpful. And then just taking a look back at the table view here, you can also see which one of these sectors are rated as a void, long. None of them are neutral at the moment, but all very helpful information, David. We are actually running out of time, though. Is there anything else you'd like to add quickly before we cap off this week's episode?
No, just quickly, just what we got the jolts tomorrow. You're probably going to start to see the volume dry up tomorrow afternoon sometime. You sometimes when you have a low volume session, be aware that everybody's gone volatility in there because you don't have enough people balancing out the trades. If you get everybody jumping on one side or something, it can produce a little bit more volatility than normal. But I don't think we're going to see that unless you get a real surprise number from the payroll number on Friday with a spike in unemployment. And I don't think you're going to see that. We're looking at 4% again, and that would be fine for the markets.
All right. Well, David, I think that's going to be enough for this week's Tech Talk. I hope everyone has a wonderful 4th of July holiday, and we will go ahead and catch you guys next week.
Don't get hurt over the holidays, Carla. Bye-bye.
Okay. Sounds good. You too.